All right. Good morning and welcome back to the Money Advantage podcast. This is Rachel Marshall and Joe DeFazio. So, Joe, I'm really excited to have you back on the podcast again this week. Thank you so much for joining us and being able to share your perspective with the podcast today.
Absolutely. I'm so happy to be here. I know it's just because Bruce is at one of his little conferences, so I know
Not
I'm paying second.
only Not only, no, Joe has been making a few additional appearances on the podcast lately, and I just love being able to have the multifaceted view and approach. And every time we have somebody from our team who's joining the podcast, there's just a fresh angle or a fresh take on something that you might have heard if you've been listening to us for years. You might hear from a little different perspective or different, a little, yeah, just something that might hit you in a different way or it might connect with you differently. So, Joe, we have been unpacking this example specifically about your financial life and comparing that as an analogy to an airplane or the flight path of an airplane and figuring out how do we consider all of the forces, the lift, the drag, the thrust, all of the things that help an airplane to fly. But then not only do we look at that, how do we look at the environment the airplane is flying in? And then how do we look even more specifically at the construction of the airplane itself or the design of the airplane? And there are so many components to this, but we had two episodes so far about how to turn your financial headwind into a tailwind, how to take the things that often in your financial life are causing all of this pressure against you and being contrary to your financial forward momentum and progress, the things specifically that are financing costs. And how do you turn those into a tailwind? How do you turn those into something that's continuing to push you forward? And you do that by changing your complete perspective about the banking process, the cash flow management system that you exist in. And infinite banking changes that landscape by putting you in a position of control and having those forces that usually are against you in most contexts instead be something that you can use to your advantage. So today we're continuing on this example, and Joe's going to really just be able to dive back in, but we're going to be focusing in on this idea of policy design today. And I think the big challenge here is that often you can have somebody say, yes, infinite banking, get a whole life insurance policy, use it by borrowing and taking loans, and they then start designing in a way that causes disadvantages or they cause problems later on down the road. And so instead of just looking at what maybe some people might say are the most immediate right in front of you problems to solve. Things like having as much high cash value as soon as possible, which might sound good at the forefront. We want to step back and look at the whole picture because we want you to be in a position to fly long term in your life, not just have something that feels good right now, or you think you're making a good decision that ends up backfiring later, or you get into a position where it hasn't truly produced the long term fruit that you had intended. And so we want to help you build your financial life to fly, not to fail. We want you to build your financial life into a position where you are moving things forward and you are having an advantage in every way. And part of that relates to not just the process and the strategy of infinite banking, but the specific policy design of the tactical implementation of the life insurance policy itself. And so today we're talking about the hidden costs of bad policy design and why you really want to be clear about why you need the right policy design to be able to help you do everything else better and have the advantages of infinite banking. So, Joe, I'm going to let that lead in, just take you wherever you want to go in terms of bringing us back to that policy design component. But you go ahead.
Sure. Yeah, and maybe I want to expand that just a little bit. Not, I wouldn't limit this to just a policy design. I think Nelson was very clear that the actually I'll read it from it's on page 38. Here we go. We are not attempting to accomplish all of the banking needs through the device of one policy. We will need a system of many policies in order to do the complete job. So I like to think of it more like your entire system, not just one policy. Now, each obviously the system is built by each policy, and we're going to describe the components of each policy, like Rachel highlighted. But try thinking larger than just one policy, um, and look in terms of the entire family system, not just the three policies or however many policies you personally have. So if you start to think bigger, like the family privatized family banking system, it'll make a little bit more sense, I think. And
And
another
Joe,
thing,
would it go ahead? I I was just gonna
no,
say, would
no,
it be fair to say that it might be more forgiving to have maybe a policy that may not have been ideally structured, but you still have it in your wheelhouse of policies? Because I think sometimes this one idea that I've got to get it perfect on this one policy, I have only one shot, and if I mess this up, I'm going to screw the whole thing up. I think sometimes that can cause hesitation to the point of paralysis by analysis.
I know,
The
yeah,
idea
yeah,
that I've got to figure out everything before I can get started, which then causes a delay in starting, which is one of the worst handicaps you can have because you want to get started right away as well. So
yeah.
I love that you're expanding this bigger, which then also allows you to make even mistakes in getting started because you're not going to be perfect at first.
Yes, and let's expand that a little bit. The only real, well, actually, I'll say generally speaking, the only real bad policy is the one that uses all of your capacity and then handicaps you from fixing it later. So long as you don't commit all of your insurability, the maximum you possibly can get in this period of your life into a policy that doesn't allow for expansion and has some serious disadvantages, you'll be fine. Like Rachel said, this is a very abundant system. So, for example, some people really favor this liquidity component early on. As long as you don't use the entire system for that purpose, you'll be fine because you'll learn as you look to like that will eventually not receive any more premium. So it'll be an organic and natural process to say, I need another policy. But the second policy, you can now take in within the context of the system as the cash value of the original policy. So that affords you to design it differently the second. And you'll notice as the entire system matures, you will lean towards the more efficient, more leveraged side of the equation, which is the base component, because you won't feel like you don't have any cash value and liquidity early on because of the pre-existing system that you've already built. So it's a natural organic expansion and it's a natural organic shift to a heavier and heavier base component over time to absorb more and more of your capital. Yeah, thank you for that clarification. I just wanted to make sure we're talking the whole system, even though we're going to discuss components of an individual policy. You got to think expansive. You got to think bigger than that. And the other piece of this, think as we're going through this, we're plugging, some people say we're starting a business. I like to say we're plugging into an existing business, right? There's a capitalization, like if you're familiar with partnerships and how they work and how you have to buy in, um, you know, so on and so forth. And the partnership exists, the enterprise exists, the insurance company's there. The co-generation is you buying into this, which requires a loan that's going to take 3, 4, 5, 6 years to pay off, and then you receive maximum profitability. And we'll kind of go through that, but just keep those two ideas. Think expansive, and you're plugging into an existing business to reap the benefits of their logistical advantages and economies of scale that they've accumulated over 100, 200 years, right?
Which, Joe,
Okay.
that just gives so much more, um, I don't know if comfort is the best word, but peace of mind of knowing that you're not starting something that has never existed before. You're not going into uncharted territory. You're not experimenting. Maybe you're pioneering this in terms of your family's never done infinite banking, or you've never had a banking system where you privatize that cash flow management system in your life before, and you are the first one in your family, and that can feel brand new, but you're not going out into the unknown waters and wondering if something will work out because you're just experimenting and maybe it's going to fly and maybe it's going to fail. That's discomforting in some ways. And an entrepreneurial thinker is willing to take on that risk, but that's not the kind of risk we're talking about. We're talking about plugging into something, a system that already works, which gives a lot more stability. Maybe that's the better word. Stability, security, this comfort of knowing somebody has already figured this out. Maybe you're just figuring it out, but somebody already has. And this whole system is already functioning well, which means I have that like catch, that safety net, that confidence of knowing that I'm stepping out into something that is known already. It's not an unknown.
Yeah, that's beautiful. Like people like I've seen so much content that like it's almost like you start this policy, then you have to figure out what to do. And it's like your capital, there's a trustee that receives the US dollars get exchanged by way of paying premium into this contract, and then the trustee puts it to work for you. It's already at work for you. You have the luxury as a limited partner in this enterprise. All you're doing is saying, I'm just going to flow my cash flow into that and let the trustee do his work or her work. I'm just pushing as much as I can into that and making them do all the heavy lifting for me. Like if you go back, I was going to share this in a minute, but if you go back to the grocery store example in the book, um, the I think there's a misunderstanding potentially that people think when you go through the front door, you're taking a loan. And really, in my opinion, you're taking a loan when you take the tea off the shelf and you're repaying the loan when you leave the store. Okay. So what the P is used for, like Becca used to say, I've said this, I love it. She's like, the peas could go in pea soup. It could be in a pot pie. You could just have it as a side vegetable. It's like, doesn't matter. Nelson doesn't address it. He says it could be any financing anything. It's how you did it. You have the system to do the financing, right? And when you pay back the loan, when you exit the front door, instead of not pay back the loan, you sneak out the back door. When you pay back the loan, you have returned the cost of goods, which is replenishing your cash value, and the margin, which comes back in terms of a dividend. So when you reinvest, you're putting the piece back on the shelf. The original cost of goods sold gets put back on the shelf, plus your profit margin gets put. Now you have two cans. So the system just is self-fulfilling by design. It's engineered that way. So yeah, there should be immense comfort in using this and the logistics and the actuaries and the engineers and the the contracts from the lawyers and the portfolio managers they have, the institutional portfolio managers. Like, yeah, you guys do all the heavy stuff. I'm just gonna shut. I'm just gonna get the can of teas for whatever I need and then put it back, and you guys do the heavy stuff. There should be so much certainty in that. I don't think we talk about that enough, but um,
Well, Joe, I
yeah,
think just that's fascinating enough. I mean, I think I think you're right, and I've never thought about it from that angle before, but if you are paying to buy those peas, then you have paid the cost of capital. You have then allowed the replenishment to happen, which is absolutely in a retail store. The purchasing, the revenue or the profitability then is able to be used for continuing to keep the system running. You're in a position where, yes, instead of taking it out the back door, which would mean you didn't pay for it, you take it out the front door, which means you did pay for it. That's that's fascinating. So yes, I think you're right that paying at the till and taking it out the front door means that you have replenished that cost, which means you're in a position where then you've taken responsibility. You've come full circle. You haven't just taken the loan and forgotten about it. You've repaid it.
Oh yeah, and like we should do another one on my grocery store example deep dive. But if you take that even just a step further, where it's so the repayment is on the one side, you're left and did whatever you're going to do. Great. On the back door, what it's designed back door in a grocery store is like where the inventory comes from. The ship comes, they unload it, and how does that happen? Well, you have to use either additional cash flow, the cost of goods sold that was returned, current year profitability, past year profitability. That's how you buy more of the peas to put back on the shelf. So it's like so people get they miss the idea that it's about the turning of the peas, which I'll relate to the airplane where we're doing round trips in a second. But the turning of the peas, it's about the profitability, not the cost of goods sold. So it's the cost of goods sold just keeps shifting from the front door, goes back to the back door, and a new can, and a new can. It's the jelly, he calls it, Nelson calls it. It's like what the little bit on top, the profit margin. If you can turn it 20 times, you make a crazy living and can retire early. So it's like, no, I have my own thoughts here, but turning the can of peas would be repaying the loan 20 times, and you can retire early. You can look through his book, and he has the equipment financing example where you start with an illustration 2, and you have 8 turns of the can of peas. As you progress through, you get to 42 turns of the can of peas by illustration 5. It's like, oh yeah, if you look at illustration 5, the amount of income that comes off of this, like the installment sale when he sells the business, and it pays him an installment each year, is dwarfed what it did in the first illustration. It was like 90,000 compared to over 200,000. Like the amount of cash value available still, the amount of death benefit. Plus, if you net out like how much he took out and extracted, siphoned from the system, it's like the numbers are silly. When you can turn the can of peas completely, that means put it back and then do it again. The whole system energizes from that.
Mm,
Oh,
so
I'm down the
fascinating.
rabbit hole.
Okay,
I'm down a rabbit
that's
hole.
awesome.
I'm sorry.
All right. So we
Back
have
with the
two
airplane.
analogies going. Let's come back to the airplane one. But I think what you're seeing from that is that clearly a grocery store can never be profitable by one selling one item and closing the doors. And that would be silly to think that that would be effective. So what you're saying is a system that's continually utilized is going to generate additional capital. So let's leave that for another, for your intrigue as you're listening, and please ask in your questions. And then, yeah, so Joe, I love the conversation about where the repayment is. So we were on the idea of starting a business versus plugging into an existing business, and that confidence of being able to plug into a system that's already functioning, already working really well. And so powerful to recognize that that is then how do we look at that environment and how do we design the aircraft, the
Mhm.
airplane for effectiveness?
Yeah, and let me share my screen here as this is coming up. It's how are we, how are we getting, how are we building this fleet for our partnership that is the airline in this example? I always like to start here. Oh, just housekeeping. I like to say I'm not trying to replace, so please don't crucify me. This is just to expand, not replace. I'm just trying to expand and apply a lot of his other um, other pages in the book and other concepts to this idea. His principles, I like to review these and just keep in mind that these build on each other progressively. And in his book, even it builds to a more realistic example. That's where it ends with the equipment financing we just talked about, where it's a literal practical study of how to bank with a policy. But his principles, think long range. And I think we discussed this last time or on a previous episode. Long range is not 30 years. Long range is 70 plus years. Long range is 7 generations, perhaps. Book plug.
I was going to say, if you think generationally, there's just so much more capacity to this because I mentioned earlier the idea of pioneering or maybe setting something up that maybe you're the first person in your family line who has thought about this way of recapturing capital, putting it in your control, and being able to deploy it in a way that is advantageous to you and not just paying finance costs to another system, another person's bank, another banking system. And if you're the first person, you might not feel or see or have experienced the compounding, the exponential power of this. But if you begin in one generation and you, like Nelson did, he utilized infinite banking. He shared the blueprint, which I know you're going to get to in a second. He shared that not just with his family, but to many other people who can capture and use the concepts as well. But within his own family, he shared the blueprint. Generation two is not only then reaping the death benefit and has reaped the death benefit from his policies, they've already had a banking system that they'd already capitalized as well. And they're able to now use, Bruce always calls it a leveraged up death benefit. Here's the premium you put in, here's the death benefit that pays out. If that death benefit is used as capital in the next generation to initiate the system, then the death benefit that pays out in the third generation is here. So you have this growth that if you were generation three or four who'd experienced this growth already, you would be feeling the impact of the system. But if you're initiating it, you need to have the vision for recognizing what can happen. And that's why I think is absolutely valuable to start with a generational lens.
Oh yeah, and apply that throughout. So that his next rule is don't be afraid to capitalize, but it should be capitalize as much and as long as possible. And that does not, I didn't say you capitalize your policy. The system needs to be capitalized. You can get it started for the first 5 years, 10 years, 20 years, and hand that responsibility off to somebody else in the family. Maybe that's part of your legacy. You're building up a policy. And when you see what happens when you pay the premium and you hand that off to the next generation, perhaps, maybe your kids, it's like they benefit from all that tilling of the ground and planting and pruning and you get everything humming for them. And they're now plugging in at everyone's favorite part, year 21 and onward, where it's a fully seasoned, fully matured policy to really get to see the compounding and the multiple on their dollars, the US dollars becoming future value. The next one, don't steal the peas. We kind of talked about that. I like to rephrase these don't because I read somewhere, I think Simon Sinek said, if you see the word don't, your brain doesn't really interpret that really well, especially when you're learning new stuff. So the positive version is restock the shelf. Don't use third party bank financing. The positive version is shop at home and shop local. Shop within the family. Only go to third party if you need it or while you're in a transition phase. Avoid it at all costs. Rethink your thinking, make room for windfalls, which we're going to talk about today, and share the blueprint. As Rachel talked about, really plugs into the legacy of this. Doesn't do anyone any good or much good if it's just one generation and then it's gone the next generation. Was it rags to riches, back to rags, or something like that? As
Yes,
I say.
shirt sleeves to shirt sleeves in three
Mhm.
generations, clogs to clogs, rice paddy to rice paddy. We see it over and over in multiple cultures over basically throughout time and throughout history. This one generation builds the wealth, the second generation uses the wealth, by the third generation using up the wealth, they're back in poverty again to start over. And so if you don't share the blueprint, you're in a position of saying, well, great, I did well during my life and I capitalized this thing that paid out a wonderful death benefit, and that generation ate the death benefit. Instead of turning that into seed to build another harvest, they ate the seed. And so you don't want that to happen.
Yeah, and I just want to clarify, the seventh one is not Nelson's. I add that in. You're not gonna find that. I believe he lived it, and that's why I called it out. That's what he was doing, as Rachel said. He shared to advisors, he shared to his family, he shared to clients, shared the blueprint. The next thing I just want to touch on is air traffic control. In our example, where airplanes are involved and an airline's involved, you need a good team that can coordinate. Um, you're the pilot, you get to decide the destination, you get to decide how things are used, but having a logistical team to help you accomplish that effectively, can't say enough what the value of that is. Um, go going down,
That's
we're gonna check.
excellent.
Yeah, we're gonna get back to right here. Nope. Okay, I promised this at the end of the last episode. We were prioritizing volume over rate, and I just wanted to share this quick slide here just to show you if the rate is the same, but the volume changes, the result is multiples because of that. Or if the volume is different, we can look at this and say we need significantly less pressure on that volume to generate the same amount. The rate is inconsequential. It can go to almost zero and produce the same of the other volume that has to work exceptionally hard to achieve, take on ridiculous risks to achieve. So volume over rate. And just another way to say this, Charlie Munger, one of the greatest investors. The first 100 is a challenge. But you have to get there because it gets much easier after that first 100. Sorry for the language there. That wasn't me. That was Charlie. um, this is just something showing that visually. Once you get past critical mass or 100,000, we have liftoff. Everything fun and magical happens on the right side of the curve, but nobody wants to do the work to get there. And just instead of dollars, if we look at time, I think this is what I promised in the last episode. The first 100,000 might saving a fixed amount and a fixed rate might take 14 years. The second 100,000 only took 8. Scroll all the way down. The last 100 it took less than 2 years. Why? Because the compounding effect of your capital is doing most of the lifting later on. So not interrupting this is really, really important in terms of wealth and legacy and generational wealth. I
Joe, this
couldn't.
is really
Oh,
powerful because looking at, we've talked about this before from a different lens, and the different lens is if you just save in a savings account and whenever you need to make a capital expenditure, you drain that savings account down to zero. What happens is it's not really so important that you're saving interest. People think paying cash is more valuable than financing. Paying cash is better than getting a loan because a loan, I have to pay interest to the bank, whereas paying cash, I don't have to pay anything. The problem is not only do you have the opportunity cost of failing to earn interest that you could have earned if it was somewhere else. So not only do you have that, but when you use a savings account or cash under the mattress or whatever method of building up cash and then using that cash, meaning when I say using, I mean draining the account to zero or taking it out of the account. The real problem is that you reset the compounding. And that's maybe hard to conceptualize. But what's happening is you're starting up the compound curve and you just barely made any traction. You say, it's not really that important to take this money out. I'm going to go ahead and take this cash out. You drop back down to the starting point of the compound curve. And then you're like, okay, I'm going to build up the capital again. I'm going to save it in the savings account. It's not really doing that much. I've earned a couple pennies or whatever, a couple dollars on my savings. It doesn't really matter that much. And I'm going to go ahead and use that cash. I'm going to take it out of the account and I'm going to go make that purchase. You start back. So you slide all the way back down to the 0 point on the compound interest curve every single time you do that. And when I say reset the compounding, I mean restarting at zero. And the problem is that most people never experience this compound growth because they don't hold on to capital long enough for it to actually matter.
I love that. And a lot of people make it about the money, which it is. That's definitely a huge factor when we're talking wealth. But the time aspect, people lose track of. If you drain your account the $100,000, you've not only reset the 100,000, you've 14 years you've reset. You've chopped off the ability to gain the next 100, not in 8 years, the end of the curve. You're only going to live so long. So you're not going to experience the benefit of 900,000 to 1 million only taking less than 2 years. You're never going to experience that because you chopped off 14 more years. So I think you 14 years to get that ability back. You're going to have to live 14 years plus two to even see that because you decided to drain the account. The time aspect is the
Oh.
unseen cost. Um, yeah, that's
That's
it's
why you cannot wait to get started with a life insurance policy. When you get the concept of infinite banking, you don't want to wait for a long time as you're figuring this out, being afraid to make mistakes. You want to get started. Bruce says small steps, but quality steps. The quicker you get started, the sooner you're in a position of being able to begin that first 14-year period.
yeah. Jedi Jeff said on a call the other day. He was like, "Well, if you could do this, obviously the best time to do it was to go back in time and do it when you were 0 years old. But if you can't do that, well, then the next best time to do it was about 10 years ago. But if you can't do that, the next best time was yesterday. If you can't do that, the next best time is today." Just to emphasize, it's the getting started. You can't make up the ground. Now, I don't want to put a false sense of urgency. Um, it's really important to start, but it's so abundant once you do. It's life altering no matter when you start, right? If you have the volume right and the frequency right, we can overcome the lost time. I don't know if you
And
were.
I'm going to add to that, Joe, because we have people who come to us who are in their 60s or even
Mhm.
sometimes approaching near 70. And they say, actually, before I say that, we have people who come to us in their 50s and they say, I know it's too late for me. I know I'm not able to get started with this. And I think the challenge can be thinking, well, I must have passed some window of idealism and I'm past that, so therefore it's not advantageous. We successfully began policies on people into their 70s. Joe, can you just speak to that idea for somebody who's saying, well, maybe I've already wasted too much time?
Yeah, and I think it's natural, but it's flawed thinking to beat yourself up and compare you now to you when you were 0 years old. Of course, if you started, hindsight's 2020. If you made let's take insurance out of it. If you made every correct stock pick over the course of your life, you'd be a bajillionaire. But you don't beat yourself up over that. That's what I mean by the next best time to start is now, because it's always leveraged. The future is like when you do this, it's always better. The
And
legacy is
yes.
always in hand. Like the next generation receives an abundant seed that would not be there otherwise.
Yes, it's always leveraged up. And so, however long your personal trajectory is, it's worth beginning whenever now is for you. Even if you're
Mhm.
listening to this podcast and it's 4 years from now, because this lives for a long time in the internet and on YouTube and all the places. So if you're hearing this and you're for the first time discovering this idea of infinite banking and you want to take advantage of this power and this compounding growth, whenever today is for you, that's the ideal time to begin.
Or and if you talk to like Becca is one of our specialists, she can wave a magic wand and make you 6 months younger. So you can go back in time for 6 months and start then if called
And
backdating. But
yes, it's not quite a magic wand, but it feels like it and it acts like it. And we've done
yeah.
that. I've done that personally on policies as well. So
Yeah.
absolute ideal move. Yes.
All right. So let's get back to the airplanes. Just I think this is where we left off. We were saying
Yep.
prioritizing volume in terms of funding your system, funding your policies. these are the charges Nelson outlined for us in the book. He specifically speaks to finance charges, the second tranche, where it's headwinds of 30 to 36, 35% here. And if we could recapture even just that, we go back to this idea. We've increased the volume of our capital. So that means we will be light years ahead of trying to save, for example, 5% versus 40%. The 40% has to work a lot, but a lot, I'm sorry, the 5% has to work a lot harder to catch the results of the 40%. So he's saying
And
if we just,
what you're referring to, Joe, is the idea that many people think I just can only eke by this certain 5% of my income in savings and putting that aside and not spending it today. And so that's the only savings that I have, which is the only amount I can put into a life insurance policy, that volume of 5%, or actually most people don't think about putting that into capitalizing a life insurance policy at all. They usually are thinking I need to get a higher rate of return on that because that's my savings, which then they're actually investing and putting it into investments that have risk of loss for the future, saying they're saving. But the concept is if you don't just look at what you say is your um, personal profit or your personal uh, income minus expenses, if you look at more than just that and you look at how can I increase the volume of capital that I'm putting into a banking system. And Joe, you're saying rather than just saying how much can I afford to not spend, you're saying how much can I look at the financing landscape that I'm in, and instead of thinking about paying finance costs to a banking institution or banking industry, how do I recapture that cost? And that is a higher volume of your income dollars that you're putting to work through the system of infinite banking.
yes. And I think that's an entirely separate episode that we can go through how to actually do that. But
Yes.
if you want the example in the book is equipment financing. And what he shows through each iteration is the person is he already has certain expenses happening in his life and is assuming them and absorbing them into the same policy by changing the direction of the cash flow and where he's getting the financing from through his policy. And by doing that, he's able to free up more, take more away from the third party banks and push the capital towards this, which you can skip to the last illustration. You could see the result of that, the benefit of him later in life. This is on top of his actual business. This isn't in place of his business. It's on top of what he's already doing. Um, pretty impressive stuff. But yeah, so and just what's the crux here? Every single dollar has this problem. It's not limited to debt and it's not just for investments. Every dollar you make has this opportunity cost. I think I've said it before, but the section of the book called "Use It or Lose It." I like to rephrase that and say, use your cash flow to pay premium, or you lose it forever. Like once you spend the dollars, they're gone. That's a bigger headwind than all of these. It doesn't matter what you spend it on. Once you spend the dollars, they're gone, and you never see growth on those dollars ever again, and neither does any future generation. Um, so that's why his natural conclusion, as you're doing this, is to get to 100% of the volume of whatever you're generating in your life, personalized for you, should flow through this at some point. Your system should organically expand to a point that meets your cash flows. Cash flows will equal premium if you're expanding when you should. Um, I think one of the benefits, like Becca came up with this. Once you're in flight and you get to 30,000 view and you have this massive jet stream behind you, 35,000 feet, you're free to move about the cabin. You have a massive tailwinds, a seasoned system of policies helping you in your financial life. You're free to do whatever you want at this point. And you'll see Nelson, and then you'll see I think David Stearns and future generations describe the fact they haven't been to a bank for financing in 30 years, in 20 years, zero financial stress. It's something foreign to most of us because we're always under the thumb of this third party that has the control of the terms and the capital. And we're always starved of capital. So we're the captive audience, right? That's what Nelson talks about um the grocery store example. We're captive to this. We have to keep going back because we're starved and we need it to do the things we need to do.
And I
But
think, Joe, it's really powerful to realize as well. I'm not sure if ever mentioned exactly how old he was. I mean, I'm sure we could probably figure it out when he began understanding the infinite banking concept. I know that he had a young granddaughter at the time, so I'm sure that we could extrapolate exactly what time frame that was. But he had policies already in force at that time in his life. And I think the powerful thing to realize, he died, I believe he was 88 years old when he passed away. And so if you look at the span of time, there was a considerable length of time that it took him. I think he said he took 30 years to get the banks out of his life, if I'm not mistaken with that timing. But it wasn't right away. He had a long history in his own personal life of utilizing whole life insurance before he even realized the power of it. And then he had a long span of time from using it and understanding the power of it until, if you measure from that, until present day when now he has passed away, the death benefit paid to his second generation, and they're continuing on this system. So, I mean, we're talking about many, many decades.
I think that's a really great point to point out, thing to point out. And I would blend that in with the idea that he did this for decades. He studied this and developed this and honed this presentation and material for decades. He was like the top salesperson, I think, at Equitable, honorable mention for like lifetime award, something like that, lifetime achievement. Like he understood life insurance. He revised his book 5 times. Anybody that sweeps what he says under the rug and just says, it's like some antiquated analogy, who knows what he's actually talking. They didn't study the material. They have no concept of how much detail and thought and prayer went into this. Um, yeah, I'm just thankful he shared it. And I'm
Oh, absolutely.
thankful, right? The group of people that actually continues to rethink their thinking and approach it with fresh eyes every time, every time. I don't care if you're in this 20 years or 30 years or if you're just starting out. Approach it with fresh eyes, hungry to learn, and you'll learn something new each time. Um, yeah, I think to say that the founder took 30 years to unwind the mess that he was in, people that think they can do it in 1 minute, it's like you might be able to get the one contract in 1 minute. You don't understand the full extent of what we're doing. You can't. It just can't be done in 1 minute. Um, just something and that's what this was. You need to like slow down. You get the concept, but applying it's going to take time.
And I know that you've said this before in a previous episode. We were just talking about the length of time to be able to master something. I mean, you can't become an experienced driver the minute you take your driving test. You can't, you had mentioned getting a college degree. It's not done the moment you decide to go to college or that you pay for the first class. It's when you have gone through the time frame. And so I think that applies as well to infinite banking in terms of getting started. That 1 minute, you might have that powerful decision to start that unlocks everything else for you, and it absolutely sets the trajectory for you to reap the benefits. But you will begin reaping the benefits, and then you'll learn more, and then you'll begin to understand it better, and you'll be able to make even better decisions and add another policy and train your kids and use the policy. You're gonna and use the system of policies, and then talk about how, I mean, there's just so much expansiveness that happens from that initial micro decision, that unlocking decision that gives you access to all of the growth and opportunity. But you can't season your life insurance life. You can't season your family banking system overnight the same way that you can't season any other kind of experience.
And just to like, if you know the contract is designed and engineered to get more efficient over time, you can't skip days of waking up. It gets it gets better over design because you woke up and paid premium. You could do the premium part. You just can't wake up faster. You can't take a nap and wake up and take a nap and wake up and say, "Hey, that was like 5 days, right?" Like no, 20. It's a 24-hour thing, and the next 24-hour segment starts. Um,
Absolutely. I mean,
okay.
I'm thinking of it in terms of like growing a baby. When you find out you're pregnant, you can't immediately be like, oh, done.
Yeah.
Baby's born. I mean, there's a growth process that has to happen.
Hmm. And there's a mindset shift too. Like there's a I think a Rohn quote where he said, "If you're not a millionaire and you find yourself with $1 million, you better learn to become a millionaire.
I love
Otherwise, you're
it.
going to lose it." And it's the same idea. Like just because you think you can have, like you bought the clubs does not make you a professional golfer. Just because you have a lot of cash value doesn't mean you know how to do this concept. It doesn't mean you know how to make this waterfall cascading impact generationally and rid yourself of all the third party banks you don't own. Um, there's a time element, and actually I'll just get to that on page 38. He talks about um, actually I read it a little earlier. This is another piece of 38 specifically to what we're talking about in terms of policy design. The objective should be to get as much money as possible into a policy with the least amount of insurance. He didn't say as fast. He didn't say in 1 minute. It's the most, as much into the policy over your life. You go back to his principles, his words, long term. How can you do that? Uh, I'm just trying to keep an eye on the clock here. We're going to skip to the different types of premium and this balancing act, right? Each policy has different components to it. The main three costs we can talk about are base premium, which is for the contractual guarantees, the framework of the contract. There's rider costs. Some of them might be term, some of them might be PUA rider costs or chronic illness type rider. There's costs that are baked in, explicit costs. And then there's out of pocket dynamic PUA premium you can pay. Those are the three main types of premium you can pay. This is just a visual of what level base premium looks like over the course of the paying period, the scheduled paying period over your life. It's a straight line. You've leveled off mortality costs in exchange for this straight line premium payment, guaranteed never to increase. The next type we'll talk about is the PUA premium, but I want to introduce it in this context. PUA premium, the value declines over time. And PUA premium buys a fixed amount of death benefit each year. So each year it's buying less death benefit. The death benefit is the target gross of that year. Cash value does not perpetually increase. It increases to the death benefit for which it represents. I'll go back to this in a second, but here's the math behind it to make it a little bit easier. I just ran a couple illustrations and said, okay, let's pay a one-time lump sum PUA premium of $10,000 in year one. What happens? Well, actually, 1, 3, 5, 7 are the years I picked. You'll notice that the cash value representation of this is about the same. So the cash value doesn't shift all that much, but how much death benefit it purchases declines. What we're seeing is the multiple, the leverage of the PUA premium is higher earlier and declines lower later, which I shared the other side because the other side is true too. When you're withdrawing, if you have to surrender the additions, the PUAs, at different points in time, if you wanted about $10,000 at age 65, 75, 85, you'll notice that the amount of death benefit that you give up for that withdrawal also declines. So when you're taking money out, this is a good thing late in life. When you're putting money in, you want to be judicious here. You can't just think every time you make a 60-40 portfolio policy design, they're all equal. You're older, which means your PUA premium is buying less death benefit. Now, it's true. Both base and PUA will have dividends that will also change these numbers. But I'm just trying to show you that PUA, out of pocket PUA, buys less death benefit over time. So
And I
this is
think
what
that's
the,
fascinating as well. So you're not just talking about over time, but so would that be true as well that somebody who starts a policy at age 65, their PUA is going to purchase less death benefit than a person who purchases a policy at age 40?
yeah. If you're relying on, well, yeah. And this is the visual representation. Like PUA premium starts out buying a lot and then it trails off. The mortality here is not negotiated or it's annual renewable. So each year, the mortality expense reconfigures to say, how much does this buy given my new age? The same dollar is going to buy less the next year and the next year and the next year. Whereas when you sign the contract for the base premium, each year is treated the same. If that's the point, they leveled off the mortality expense. So if you paid 10,000 and 10,000 each year, the base will not change. The death benefit will not change. It's not going to go down. Whereas
So Joe,
PUA,
I've
oh,
heard
go
and
ahead.
seen this from different perspectives before, but the visual just helps a lot. So the base then takes your mortality cost, which is obviously much lower when you're 1 year old than it when you're 100 years old. When you're 100 years old, your mortality cost to the insurance company is much higher because you're much more likely to pass away at age 100 than you are at age 1. And so in reality, for the insurance company, your mortality cost begins very low in your early years and increases over time. But what they do with the base premium is they level that all out, which is your green line. They
Mhm,
level out the cost of insurance, meaning that the 1 year old and the 100 year old, provided it's still under the same policy, you're paying the same amount of um, mortality cost each of those years, meaning that's why you're continuing to have your base premium dollars purchase the equal amount of death benefit every year over
mhm.
the life of the policy.
Yeah. And like this is why the dividends really come into play. Like if you think why the dividends get bigger and bigger and bigger, if if you're essentially exactly what Rachel said, you're overpaying in the early years. At 0 years old, you're paying a lot more than you need to for that cost of coverage for that year. But that's used to fund the other years. At some point, usually around 15 years, it's about the cost of acquisition for most mutual life insurance companies. Around that 15-year mark, that's when, or maybe somewhere 15 to 20 years, I think that's what Nelson put out there. But at that point, almost every dollar is almost unnecessary to meet the original obligation. The risk has been completely mitigated from the insurance company's standpoint. So they take the money in and they're like, okay, do we need to, put anything here? Nope, everything checks out. We got a contingency, we got the contingency. What do we do with it? Well, we put it to work because we have to, and then we give it back in the form of a dividend. Whereas there's no, how would you put it this way? Because of the ever-changing mortality of the others, the PUA premium, it has a lower contractual increase. It's capped off. The death benefit number is the number the cash value will eventually grow to. Well, if this is going down, the growth is muted over time. You still get the liquidity benefit, but the increase part of it is lower and lower and lower the longer we go. Um,
That's fascinating, just in terms of the death benefit portion of your PUA premiums being the younger you are, the earlier in the policy you are, the PUA premiums are going to purchase more death benefit than they do later on in the policy. The visual is very helpful for me. The idea then is that yes, your PUAs are going to do a lot in terms of cash value in that particular year because you're purchasing a paid up portion of insurance that never requires any additional premium for that amount of insurance that's bought in that particular year. And so as you're doing that, you have all of this additional cash value that you're building in those early years, which is why there can be such an emphasis on get as high of PUAs as possible into your contract. Meaning, some people have this, maybe misguided would be a good word for this, idea that the most important thing is day one of the policy, which is get as high of cash value so that you can borrow out what you paid in day one. And that's the extent of the vision for the policy. But if you zoom out and look bigger picture, not only do you want a lot of death benefit, you also want to have a lot of base premium contributing to that level death benefit because you have maximum efficiency in terms of the growth of dividends into the future.
and just as this is exactly what you were just saying. So if we have a really tiny base all the way at the bottom here, the green line, and we do everything we can to get liquidity early, well, there's certain things you have to do to make that happen. Like there's IRS rules and so on and so forth, regulations that will assess whether this policy or contract is a triggers mech status. To avoid that, you have to artificially press the death benefit up so your base can receive an artificially high TUN. Okay, but that term, that rider, typically falls off. So as that falls off, well, then we go back to the original amount, in which case it's probably completely, the capacity of it is completely maxed. So now we're down left here paying peanuts. And now, what do we say at the beginning of this? Every dollar you have has the same problem. Every dollar you earn, every dollar you spend has the same problem. You have no way of getting this on your compounding curve now. You have no way of capturing this and making sure what you spend never leaves your personal economy. A better way to look at this would be, can we look at this from the point of my maximum potential first? The system's maximum potential first. How do we best use that potential to absorb as much cash flow over the course of our life?
So
And one of
Joe,
the,
go ahead. I want to make sure I understand this picture and before you move on from it, but
yeah,
continue if you're still here.
yeah, I was going to say the fear of that is it sounds like, well, it will. I'll come back to this so you can assess. This is what the balancing act looks like. We want enough liquidity early on without sacrificing this. So our opportunity cost shrinks to that. So the difference in opportunity cost, this one will allow you to expand and have a second policy. And the two policies long term will be greater than this one policy. Again, going back to if we look at the maximum potential of the system of policies, I'm not comparing one policy to another. I'm comparing the entire maximum potential of the entire system. 3 or 4 of these will dwarf this. But this guy is stuck because they used all of their potential with that artificial term. They used it all in the first year. And great, it looked wonderful in the first year. And now they have this lost decade or 2 decades until their term runs out where they can convert it. And now, what do we say? We'll go back to this. If we restart the curve when we're 60, when we were 40, we got to pay that 14-year whole again before we start compounding. So there's a point to doing this, the liquidity. The liquidity needs to match your cash flow needs. There should be an in-depth discussion of your cash flows and the financial landscape you have and your financing right now and how to strategically reposition and redivert those dollars into a system that benefits you instead of the third party bank. That's got to be part of the process. And last thing, and I'll get it back to you so you can touch on this. We talked about this before. Maybe it's another episode. We're already over an hour. Sorry. But
That's okay.
if you have cash value, right? Let's pick a number. Let's say I need to spend 100,000. Well, you could have 100,000 of cash value to do that. Or you could have 50 and take two loans. Because 2 times 50 is 100. Or you could have 10,000 and take 10 loans. Because 10 times 10 is 100. So the frequency and the volume can equal the spending you need. If the cash flow is the same, if you had it before you even heard of infinite banking and you were spending it that way anyway, the cash value actually doesn't have all that much emphasis. We can emphasize it to the correct degree without sacrificing the long term because we're thinking long term. So if you remove like Nelson's principle, if you take that generational thought out of it, if you take the business approach out of it, it's like, yeah, of course, it leads you here. But if you actually listen to all his principles, this is the type of thing he's looking for. Enough cash value to meet your needs. And when it stops meeting your needs, it's time to expand, which is impossible if you've already used all your expansion. The result will be this 100% of your cash flow flowing into your system of policies eventually. Sorry, go ahead. I'll get back to that slide.
Oh, this is really great, Joe. So what I'm seeing here is you're talking about the black line being your death benefit, correct?
The black line was just the trajectory of their premium, their ability to pay premium.
Okay. Okay. So
Right.
then if you are looking at the ability to pay premium, you're trying to put, so essentially this picture then is showing putting all your premium into policy one.
Yes.
Or, okay. So in putting all premium into policy one, that, can you explain why is there the, okay, so putting all your
So
premium into policy one is that short upward spike, but what is the downward part of the black line then? What would you call
yeah,
that?
sure. Let me draw two more lines and say this is the term rider that you needed to do that. So when the term rider falls off, you cannot continue paying that high PUA premium. You have to stop because the artificial scaffolding is gone. Now we go back and look at the base premium because the death benefit is now gone. They recalculate and say, well, wait a minute. Now how much death benefit do you have compared to how much premium, compared to how much cash value? That relationship has compressed so much, you can't put any more PUA premium in. So the PUA premium ends or gets very small, almost like it's not worth doing because it's so small. And you're left with this, whatever the base premium is left. Some people will say 1090, for example, the 10 would be the base at the bottom, the 90 might be the PUA. And this blue thing I just drew was the term to allow that to happen. And then the term falls off. At some duration, 10, 20, 30 years, it falls off and your ability to pay is gone, but we still have the need to spend. There's still cash flow needs in our life, which now has this huge opportunity cost.
Which then at that point, you could also start an additional policy. You're just later in terms of the starting point of that policy, which means that new policy is gonna start a new compound growth curve, but your overall system is still continuing to expand whenever you're starting new policies.
Oh yeah. And like if you think of it, and it's pretty accurate with that little graph I showed where it takes 15 years. Well, that's the cost of acquisition I talked about. That's a properly seasoned policy is going to be 15 to 20 years. So starting a new policy here means you've got to wait 15 to 20 years before it's fully seasoned. Like, or if you didn't do that, you could start another one here and here and here. Like, so you're stair stepping in. So your efficiency is greater long term because you didn't use up all your insurability for this. What did I call it last time? I think back alley degree. I think that's what I call it. It's
I
like
don't
maybe
remember.
you can go and talk to somebody and they can print up a degree for you and hand them all the money in 1 minute. Now you have a bachelor. There are repercussions to doing that. um,
Absolutely.
and I think just one last thing. I was going to talk about the income aspect of this. Nelson, in his equipment financing, gives an example of being receiving income late in life. It's the equivalent of the sale of the business he describes in the grocery store example, where it's like an installment sale, some huge number where now they're going to pay you 100 or $200,000 a year for the rest of your life. Um, it's in a micro example, the airplane does this when it's getting to its destination sooner than it should have. It'll dump the excess fuel. Or it's the same idea where you're just saying, hey, we got there. We got to what I wanted to do. Now it's I'd like to receive the fuel. Everybody dump the fuel. And it's this, you know, toward the end, the owner can perform a calculation, say, hey, give me my cost basis back, essentially. Everything I put into it, I can receive back. There's a couple different levers you can pull to do this, but I can receive it back through and still leave a crazy, um, awesome legacy, death benefit. Then inevitably at the end of life, the remaining business is sold. Your partnership share sends to your beneficiary. No questions asked. Um,
Absolutely.
I think without
It's
going like we'd have to unpack a little bit more if we are going to keep going, but I think
and
there are trade-offs, and I think if you're with a qualified person with those three components of your premium for your contract, it's tempting to go this route. It glitters, it shines, it's wonderful. People in favor of this are selling cash value and a loan provision. They're not sharing the blueprint. They're not actually teaching and educating Nelson's work. This works. It does. You will have cash value. You can use the cash value, but it's not Nelson's work. Just be aware of that.
well, and
Be
I
aware of
think
what you're buying.
the benefit to, again, kind of coming back to what we said in the beginning, don't allow your analysis to prevent you from getting started. Anything that you start with, when it comes to the desire to utilize infinite banking, the desire to recapture the banking function, the desire to control your capital and preserve it in a location that you can access and use for now and for future generations, and have this system that you're building up utilizing a specially designed whole life insurance policy, you're going to be in a position that whether you had the exact perfect amount of base premium to PUAs or not, you're going to put yourself in a better position if you began today rather than waiting. So, the value of understanding all of this is that ideally you would optimize every policy and you would optimize every policy as you're creating this entire banking system, and everyone in your family would do it as well, and then the next generation would all utilize this concept as well, and the following generation the same thing. You have so much capacity for exponential growth to be in your favor if you understand these concepts. And so the value in showing this to you is not to make you regret a past decision or to, cause shame or any kind of frustration about something that you made a past decision in a policy maybe that wasn't ideal, or that you haven't begun policy yet, or that you are just learning about infinite banking for the first time. The goal that we have is to expand and show you what the ideal system is, so that as you become aware of components of this, you can begin to take action and let those actions continue to open those doors to even better and better actions, so that you and your children and your grandchildren and beyond can just continue to be blessed. And when I say your family line, I mean, there's a lot more than that as well. You can have policies that you have a beneficiary be listed as a charity or a nonprofit organization that you want to fund. There's not only the benefit of blessing your children and grandchildren, but there certainly is so much more that you can do in the world by having this system working for you and then also having the death benefit. So
Uh,
go ahead, Joe.
oh no, go ahead. Go ahead.
I was going to wrap us here. So you go
Oh,
ahead and before I do.
do you mind if I give like just a
Yeah,
couple like ideas for people to think through their system,
absolutely.
how to measure it? And just one last detail on when you're talking premium, I didn't say it here, but there are premium, different types of premium have different value. And we kind of talked about hinted at PUA and base. Um, I also wanted to say that the mode at which you pay premium changes the value of what, and you can see this, go to your person or your team and ask them to run some type of illustration that has X amount in base and as much PUA premium as you possibly can, paying annually, not $1 more or it'll mess the policy. Then ask them to copy the illustration, and all they do is shift from annual to monthly, and it will mech the policy. And the reason is it will compress. You'll have less death benefit, and you will have paid more premium because there is a charge for paying monthly. There's a convenience charge. So there are a lot of moving pieces here that your team should be looking out for. Um, that the type of premium you should be measuring. Am I paying monthly, quarterly, annually? Am I capturing my maximum insurability? Do I have the right to expand my system? Um, how much of my insurability is permanent base contractual death benefit? How much of it is term? How much of it is paid up additional death benefit? Um, how much bonus insurability can I lock in? This is for kids. If you get a policy on a kid, you can add a rider that guarantees their right to buy at different periods in their life, 10 times. So, for example, maybe that's an extra $1 million that they wouldn't normally qualify for, but because you had foresight, you put it on their policy early. What's the maximum affordability? How much premium will these companies allow me to pay? And of that, how much is base? How much is a rider cost for premium? And how much is PUA? Um, keep track of what's the remaining PUA that we can pay this year, right? What's the remaining premium affordability that we can now expand? If you have a bonus or you get more income, you get a raise of some sort, new clients that really push your business up, that means your affordability went up too. Um, analyze things from a cash flow perspective. If cash flow isn't part of the conversation, it's not Nelson's work. If it's not, that's what banking is. Banking is the studying of the cash, the movement of cash. What he describes it of when he talks about blood circulating and what it's cash flow. If someone's not studying cash flows with you and they just throwing illustrations, I'm sorry, it's not Nelson's work. You might be able to do some similar stuff, but it's not Nelson's work. Measure your cash flow. How much of your money is coming in the household? How much goes into your system? What's that ratio? How much of it is base, guaranteed for life, and how much of it is will eventually go away? We just learned PUA will go away, just like term goes away. There's some like metrics that you might want to look at when you're assessing the efficiency of your system, not just how much cash value do I have. That's a different conversation. You're in a different ballpark. You're not talking banking.
I think that's really helpful because Joe, you just expanded to about 11
So
questions. You can ask yourself to understand the nuances of your banking system, as opposed to the one question, how much cash value can I access today? And when you just look at it from a cash value perspective only, that is one of maybe 11 or possibly even more components of a well designed, efficient system of policies. And so, Joe, there's so much more that we will continue to unpack through the podcast, through things that you've brought up today, because I think it's really helpful for somebody to have these tools to begin to make decisions and think about their financial life from a perspective that allows them to continue being as efficient as possible. So we're going to go ahead and wrap up here today. Thank you for being with us, watching live. If you have questions, just go ahead and drop those into the comments section. We'll see those after the podcast. You can email us at hello@themoneyadvantage.com, just asking a question. And that can be, I didn't understand this point, or I'm wanting to further grasp this particular concept, or can you unpack this further in another episode? So those kind of questions, please put those in the comments. Please email us. If you have questions that are directly relevant to your situation, your cash flows, your ability to begin a policy, your ability or desire to expand your family banking system, your growth and utilization of privatized banking and infinite banking in your own life, in that case, go ahead and book a call. Go to themoneyadvantage.com and drop in on our advisor's calendar, because what you're going to do by that conversation is you will begin to take that perspective into your financial life and figure out how you can optimize for today and for the future, how you can expand the length of time that you're looking at your financial life so you can be in a position of making ideal decisions that will impact you through a banking perspective. And so I encourage you to have that conversation. It's not a commitment to have to work with our team, but it is a conversation that you are being invited into really do some work on your financial life and get the clarity that you need to be able to make decisions going forward. And I promise you it'll be worth your time. So thank you for being with us today. Please remember, in closing, success leaves clues. So model the successful few, not the crowd, and build a life and business that you love. We'll see you next time.